I want to go through a few things related to the politics of COVID. We always talk about economics and markets and politics and policy in our world because that's how we invest. At Trustco, we do always consider the political and economic backdrop when we invest. And then I run a fund called N3L Fund, and we're very focused on policies that are going to rearrange the economy in ways that are usually undetectable among your average analyst. So I want to do a disclaimer here. What I talk about here and always is political, but it's not partisan. And what I mean by that is, in my opinion, neither party has a monopoly on bad ideas, and that's a fact. So Republican or Democrat, it really doesn't matter to me. I'm looking for the policy. I'm looking for the policy change, how it's going to rearrange behavior among participants in the real economy, and then prices. We invest where policy meets price, and it's indiscriminate of who is in power or what. If you have a Democrat or Republican by your name. And I'll tell you, since COVID, that the politicians are behaving as usual, like children in a scary movie. And if it means the Fed or if it means the FDA, they're behaving, as we always see in times of crisis, irrationally, out of control, and we'll be living with their policy decisions for decades, if not for generations. So I'm very worried personally, very concerned. You know, little things like, when are schools going to open? You know, I mean, a lot of parents out there don't even know. I got a brother with two children graduating from high school. One's going to college, the other one's not. She's going to stay home, at least for one semester. So there's a lot up in the air. I'm worried that when they finally get around to, starting the schools, that our kids are going to be too old to really, throw erasers. They're just not going to be as fun. Maybe the teachers would like them because they're all falling asleep, but that's an issue. One good thing about COVID is the amazing, the memes that are going around, and the tweets. They're so funny, and I found this one to be delightful here because I feel like we're in a country that's completely gone mad. So Canada must feel like they live in an apartment above a meth lab. I just laughed when I saw that. It was fabulous and very much kind of reflects my feelings. So anyway, we're going to start the webinar now, really on some serious topics. I'm going to review, honestly, what we've gone over in the last several webinars, which is basically how this market, the stock market, is engineered by the Federal Reserve. And here's just an example of all the various acronyms that the Federal Reserve, these programs the Federal Reserve enacted after 2008. You can see there 2009, the big dip in the S&P and Operation ZIRP, which is zero interest rate policies. Then you had another dip in 2011 when they did Operation Twist. And then when we weren't even in a recession, they enacted QE. So quantitative easing was employed where the Federal Reserve basically started buying bonds, billions of dollars of bonds, when we weren't even in a recession. And that's part of the reason that we are, I think, painted in a corner. The Fed has painted themselves in a corner now where they can't return policy to normal levels. They can't raise interest rates. They're going to have to do this until we have a crisis. That, when I say do this, I mean print money. So then you see the Yellen pause, which happened in the December of 2015. We had a little hiccup there. That was when she was telepathing to the markets that she was going to start raising rates and would raise them 3 or 4 times. And she did it once, the market fell. And then she came out and apologized and said, just joking, we're not going to do that anymore. And you can see the S&P rallied like a scalded dog after that. Then you saw, Fed Chairman Powell comes in as a hawk, and he talks about rate increases on autopilot. In late 2018, the market fell 20% in December. It was the worst Christmas Eve I'd ever had. And then he came out and said, "Oops, just kidding. We're not gonna. They're not on autopilot." And then you can see the market rallied. Then he ended up switching from rate increases to rate cuts, and it rallied the market. Then you have the COVID crisis. You can see the market falling and then move over capitalism. And I actually did a webinar on that move over capitalism thing, because the Fed now has basically taken over the world. And I will go through some of that right now. I did a webinar called Sinners in the Hands of an Angry Fed. Jonathan Edwards gave a fiery sermon in Plymouth called Sinners in the Hands of an Angry God. And I think that that's what we have now, is a godlike entity called the Federal Reserve, and they're angry. Here they're changing their mandate, which is subtle but significant. It says here that the Federal Reserve is preparing to effectively abandon its strategy of preemptively lifting interest rates to head off higher inflation. Remember, they were very concerned about inflation, and if they sensed inflation was rising, they would actually raise interest rates preemptively. Well, they're not going to do that anymore. They're going to let inflation take hold if it has to. In the second paragraph, Fed officials will take a more relaxed view, and they're going to make up for past episodes in which inflation ran below the target. And so this is a significant change in Fed policy. They've been very, very, my picture is not up. So what do I do? Keep going. Oh, I don't, so they have just changed their mandate completely here. They've gotten wilder than ever. So Biden wants to even change it further. Here's news where he thinks the Fed should be involved in solving the problem of racial equality. I'm all for racial equality. I'm all for bringing the lower wage earner up very much. But this growing disparity between rich and poor is 100% related to the Fed. You can find that in my prior episodes where I've gone through why the Fed has pumped up asset prices. And then under Barack Obama, a very, I think, attractive president, very nice person, likable, but he had a very aggressive stance on regulatory policy. We laughingly call it his regulatory jihad around here. He regulated businesses so aggressively that they ended up sending their manufacturing to China and cutting their wages and replacing workers with robots and other, cutting costs. And what it did was it just hurt the lowest wage earners the most. So now the frustrated politicians reacting to a frustrated populace are looking for the Fed to solve this problem. This, my friends, is wildly dangerous and irresponsible. This is going to lead to, I think, a very troublesome period of time. Look at the letters in bold there. The Fed should aggressively enhance its surveillance and targeting of persistent racial gaps in jobs, wealth, and wages. Now, listen, you think the Fed is aggressive now? It's going to get 10 times worse. What are the ramifications? Well, the dollar declined on those comments, and I think that a weaker dollar is going to be the result of the Fed money printing, and so there's going to be some investor ramifications as a result of the weaker dollar. First off, shorts on the U.S. dollar picked up substantially immediately after the Fed comments. Now, investment managers around the world are, expecting that the dollar is going to fall, and it certainly should. Here is just a picture of M2 money stock going back a few years here to the last recession in 2008. You can see where the money stock barely increased, even with all the zero interest rate policy and QE that Janet Yellen was doing. The money supply did hardly increase at all, but look here lately, it's increased substantially. So that is obviously dollar bearish. We've had a record flow into inflation protected ETFs here. And so people are starting to worry about inflation. So before you ever have inflation, you have expectations of inflation that go up. Here is something that to me is very shocking. The market is now betting on negative rates. This is the Fed funds futures. And you can see where they're expecting the Federal Reserve to follow the European Central Bank into negative rate territory. What that means is that, well, right now, over $16 trillion in sovereign debt is got a negative interest rate. And now, though it is against the law for the Fed to do this, it's against their mandate, they'd have to actually change their mandate formally. The expectations among market participants is that they're going to have to do it. And my guess is, I'm telling you that they will do it. They'll have to do it. They're going to do it. And you know, they've already broken the rules and gone rogue by buying junk bond ETFs. That was illegal. They were precluded from buying securities, period, except for treasuries up until recently. And they set up what's called special purpose vehicles, SPVs, and the treasuries conducting these operations now, but they're borrowing money from the Fed to do it. And they are now buying specific securities, mostly junk bonds and bonds of companies. So they've gone rogue. They're going to go even more rogue later when they're going to buy stocks and probably move rates to negative territory. What happened? Emerging market currency started rallying for a change. So there's another effect. When you have a falling dollar, you've got some things that become interesting as an investor, and emerging markets are one of them. Emerging market currencies are going to benefit, but also emerging markets that are loaded with natural resources, because you probably will have a commodity boom as a result as well. This is fascinating here. So this is just what is going to be necessary over the long period of time from the Fed to make up for the policy gap. You know, to fund the U.S. government, it is projected that the federal government is going to be running $3 trillion deficits this year, and that it goes up from here. And in order to fund that deficit, the Federal Reserve is going to have to continue buying treasuries, monetizing our debt, and injecting money directly into the government so they can pay their bills. This is not only risky in some ways that are hard to even comprehend, but it's potentially illegal. And more importantly, it means that we will likely end up with inflation, because the Fed wants inflation. They want it and they will get it. They always get what they want. This is just interesting because equities are pricing in a pause in the economy. This is just equally weighted sectors and how they're performing. Cyclicals and defensives are not doing well. Those are always a sign of economic well-being, and they're very weak here. What we talk about around here is the market structure. You know, is it healthy? Or how about the dispersion of returns? Are they healthy? And the answer is absolutely not. Amidst a monumental earnings decline in the S&P, you're seeing the S&P hit new highs. And one good thing is that for hedge funds like mine and for stock pickers, there's an opportunity to perform finally in this environment because the volatility's picked up. So it looks like since April, hedge funds are outperforming the S&P, and boy, that's the first time in many years that that's occurred, maybe a decade. So we too are performing very well in this environment, thankfully. Stock picking might be back. I can't guarantee it, but it might be. This is just another sign of how weak the economy is. Permanent business closures are now outnumbering temporary business closures, and that is not going to go away, folks. August will grind on, September, October, November, the election, of course, December. The economy's not going to snap back like the markets have at all. We're not going to have a V-shaped recovery. This COVID crisis cut into muscle. So we're going to see, I believe, and we believe here, that it's going to take years to get back to 2019's growth trajectory and GDP growth trajectory, years. This is just a sign of its GDP, so it's only reported, you know, every 3 months, and the markets rallied, obviously, and GDP is still collapsing. So this is a big gap between economic performance, the real economy, life on the ground, and the markets. This is one of the worst quarters of GDP in the last century. There, Q2 2020, down 32.9%. And again, we do not expect a rapid snapback in the economy to follow the markets. The markets are extended. Market breadth is narrow. Weak stocks are outperforming and interest rates are falling. Remember, I talked about market breadth and the dispersion of returns. I'll go into that. This is one. This is a surge in momentum among the NASDAQ 100. Really, it's about 5 stocks: Facebook, Apple, Amazon, and then a few others are well above their 100-day moving average. And they're extended to such a degree that it's the first time it's been this extended, overbought, if you will, since 2000. So we're just very wary of this market, and we would advise you to be very wary as well. FOMO is a new term I've heard, fear of missing out, and it sucks in everybody at the last minute. I can't describe to you when or where or how the next downturn will happen, but I think there's going to be a lot of people disappointed who are buying at these levels. This is the NASDAQ versus the S&P. Again, surpassing the 2000 peak. It's a relative valuation story here. The NASDAQ crushing all the other indexes. And by the way, again, it's about 5 stocks. 5 stocks, or 4 stocks really, comprise 70% of the NASDAQ's move currently. No, the S&P's move, forgive me. It's very concentrated. And this is the dispersion of returns I'm speaking about. Of the S&P 500, this is the number of stocks outperforming versus underperforming by more than 10%. So the number of stocks outperforming by over 10% is falling, 22% here. The number underperforming by over 10% is rising. So again, this is just a kind of an X-ray of the market itself, showing that it's not very healthy. The dispersion of returns and performance is very weak, and it just shows some risk. Unprofitable companies have rallied far more from the bottom than profitable companies, and this is by design. When the Fed bailed out the economy and bailed out corporations, of course, they were bailing out the weakest and most indebted companies among us, which is what bothers us, to no end. A lot of these companies were managed irresponsibly. They took on outrageous amounts of debt. They bought back stock. They paid executives great big, bonuses for doing what? Buying back stock. The S&P, by the way, the companies in the S&P 500 did not grow last year. S&P earnings growth was 0, and yet the stock market was up 30%. Then you have this COVID crisis step in, by the way, which was made many times worse by the fact that the corporations had too much debt. The Fed comes in and bails it out. And of course, those companies that were on their deathbed are the ones that rally the most. So again, it's just not healthy. Back to market breadth, percent below 52-week high. So the number of companies that are below their 52-week high is very high here, and it just shows that the market breadth and the dispersion of returns is extraordinarily weak. And then insider transactions, insider selling right here is very high, and it may be approaching an all-time high. Insiders know very, very well what's going on in the economy and on the street and in their own businesses, and they're selling like crazy. So it's extraordinarily bearish despite today's move up and the everyday grind up. This is someday we're going to have a train wreck. Don't know when again. And then you're also seeing a historic level of dividends being cut and suspended in the first half of 2020. So companies are having to preserve their cash. Again, fairly bearish if you ask me. And then debt deficits in the dollar. We're going to review that if you don't mind here. This is cumulative corporate bond issuance. Remember, we came into the COVID crisis with a record amount of debt, by the way, corporate debt. In fact, over 60% of NASDAQ companies had junk bond rated debt. And that was a record, and by far a record. There was a record amount of BBB debt outstanding, which, by the way, is one notch above junk. And a record number of that amount of that debt was looking to be downgraded. And here we come into the COVID crisis. And since the COVID crisis, you've seen a record amount of corporate debt issuance. So $1.5 trillion of new debt has been issued. Debt upon debt upon debt. And remember, the US government debt is approaching $3 trillion this year. So if we were engorged with debt coming into COVID, we are that much more engorged with it today. And it is nerve-wracking to me to see a market continuing to march higher on hopes and dreams of a recovery, and the amount of debt that's being accumulated both corporate and both in at the government level, but federal government and state level, is extraordinary, unprecedented. And to me, it just is a toxic combination, which I believe just is, it's like a powder keg you saw in Lebanon, the explosion yesterday. That's what we're looking at, I believe. Here's the dollar versus the federal deficit. So it's a little stale. The dollar is rolling over here, but it always tracks with the deficit, as you can see over time, going back to 1987 here. And the deficit, of course, is the red line, and the dollar is the blue line. So again, I'm projecting a weaker dollar, and we'll talk about what to own. Precious metals is one thing you can own. Look at gold there, the blue line, and then the commodities are not rallying, which is the CRB is a commodity index. Commodities are obviously what everything you think they are, which would be like zinc, cotton, all the soft commodities, which are soybeans, wheat, hay, cotton, land, and all the metals, and then oil, natural gas. These are commodities, obviously. Anyway, I'm predicting, or I'm expecting, a rally in commodities, especially if the dollar continues to fall, and if we get that phantom inflation that the Fed is so eager to create. So this just shows how commodity stocks have underperformed so aggressively relative to the Dow Jones. They're very, very undervalued here, and I think that this is a great place to go fishing if you can't stand to buy Moderna or some hyped up COVID stock, or maybe Tesla, or maybe even worse, Nikola, or companies that don't even have products on the market, no revenues, and that have $30+ billion market caps. This is not reality. And so it's hard to step up and buy those stocks. But here you can go fishing on some with a macro tailwind, which would be the falling dollar, and again, perhaps inflation. Gold, back to gold. Now, we've held a number of webinars. I've been giving speeches for years talking about gold. And you can see here where webinar number 1, April 9th, I was predicting or begging people to get a position in gold. Webinar number 2, I begged them again to get a position in gold. And I dedicated webinar number 2 to gold and silver. And here we have GLD, which is the ETF of gold, up 21% since my original webinar number 1, and then of course GDXJ, which is the ETF of small cap gold miners, up 83%, beating, by the way, the fabulous Nasdaq, everybody's favorite kid. So we think that this will likely continue because inflation really has not showed its ugly head, but the Fed is determined to get inflation, so they will. So I'm very excited about the prediction that worked. I'm still bullish on gold and silver very, very much, and I'll go into why. Oh, gold prices year to date, again, beating the NASDAQ, the cool kid in the markets. GDXJ versus 10-year gold. This is interesting here. So if you look back there at 2011, the GDXJ, which again is the ETF of small cap gold miners, junior miners, rose in the 2011 rally more aggressively and earlier than gold, GLD being, the gold's the 10-year chart there. And basically they were at parity there in 2011 where the arrow is. Of course, now you look at gold and then you look at the miners, and they could go up quite a lot from here. And we expect that gap to close. And the reason is, at $2,040 gold, where we are today, we have a group of gold miners that are smaller than the ones in the GDXJ, incidentally, that have, the cost of their gold, all-in cost of production is like $1,000. So they've got 100% margin. Okay, it's all cash flow. These are fixed cost businesses. and they're not variable costs. So every dollar of revenue growth falls to the bottom line. There's no industry group in the market that is making this much money currently, and gold does not have to, remain at 2,000 bucks. They're printing money at 1,700, where we were just 2 months ago. So I feel very good about the coming earnings season for the gold miners, the companies, the equities, this current one, the next one, and the next one. They're going to be crushing numbers. I showed you that dividend chart where the record number of companies are cutting or suspending dividends. Well, guess what? In the gold patch, in the precious metals equity space, numerous companies are raising their dividend or initiating a dividend. They're buying back stock as well, and an M&A cycle has just begun in earnest. We expect a significant amount of M&A in this group. It's one of the exciting groups. This and like I mentioned earlier, commodities. It's a place you can fish. It has strong macro drivers that are relative undervalued and that have real businesses. Okay, little debt, huge cash flows, and very modest multiples, and they're going to be crushing numbers. Who wouldn't want to own that group, even at gold here where it is? This is gold versus CPI in real terms, showing back in 2000 in the 70s, and that sharp increase there on the left of your chart. We still got a ways to go here. And then GLD assets that are a record. In other words, finally people are finding gold an attractive investment, and there's momentum behind it now. There was not when we mentioned this earlier in 2020. And then silver's undervalued relative to gold significantly. They usually trade, as you can see in this chart, somewhat in tandem, but they're decoupled. Silver, by the way, is mined as a byproduct to things like zinc and nickel. So it's not 100% pure play on, play against the dollar or inflation. It's got other industrial, uses and so forth. But this gap should change and close. So silver is a very attractive play to us. And then here's gold versus the 10-year real yield. And look how they track each other so aggressively. And the yield is something I'm going to talk about now in a minute. Actually, I'm going to get to the yield. No, we already talked about the yield. The yield, remember, Fed funds futures investors are expecting yields to go negative. So that would be extremely bullish for gold if this chart holds to its prior pattern. Okay, that's what I'm trying to say. Now, this is the damnedest thing I've ever seen. The politics of COVID. When I mentioned that the politicians are acting like children in a scary movie, they are. And the Fed, we've seen what they're doing. They're throwing everything at this problem. They've printed $3 trillion of new money. They've run in and bought bad debt from companies trying to bail out the world and save the world. They're devaluing the dollar. And now the Fed's going to try to solve racial inequality. That's like putting a bratty 5-year-old child in charge of your bank account. I mean, the danger of that, folks, to me is cosmic. I mean, I almost can't sleep at night thinking that these people are going to change their mandate to right the wrongs of the world using what? The dollar? Money supply? There's such a disconnect between the needs of society and their tools for solving those problems. It's astonishing. Back to this. Here we have the FDA, Trump included, by the way, going berserk to try to find a cure for COVID. They're not doing this logically at all. There are hundreds of companies out there that are trying to, develop a vaccine or a treatment that are being ignored. One of them is one of my favorites, Cytodyne, CYDY is the ticker. Leronlimab, do some work on it. It has the potential to be a game changer in this effort to find a cure, but it's not part of the cool kids club. It's not an insider. They don't have $1 billion to buy lobbyists with. But here we have the politics of COVID. Corporate insiders have been selling. First, they issue a press release touting a half-baked trial with unsubstantiated partial results. Stocks rally and they sell into the strength. and they make tons of money gaming the system, counting on what I just said, that politicians are acting like children in a scary movie. Look at this one. This is the treatment guidelines panel assembled by our vaunted government to help the government ascertain their policy strategy as they try desperately, and again, like children in a scary movie, to find a cure for COVID. And 8 of the 20 people are on Gilead's, or Gilead, I never know how to pronounce it, on their payroll. So these are people, okay, paid employees or consultants of Gilead that are counseling the government on what they need to do to address this problem. That is what they call the cat watching the hen house, fox watching the hen house. You can see on the right, 34 state attorney general urged Trump to end outrageous Gilead monopoly on COVID-19 drug. That's remdesivir, which, by the way, has very sketchy safety data. Fauci said the other day that it basically affected the trend in hospitalizations. That is not a scientific term, folks. It's never been used before to see a doctor or a scientist make a decision based on a drug that changes a trend. Okay, it's basically outrageous to me. Look at this one, Moderna, which is talking about the cool kid, man, based in Cambridge, Massachusetts, okay, full of insiders with the government. One of Fauci's lieutenants had to step down from his position because he was on the board, was a big shareholder in Moderna. Okay, Moderna does not have a product. They've got a kind of interesting new approach to vaccines using messenger RNA. I'm sure you've done your work on it, but there's no product. They're in the early stages of a trial. Look at this. Here, the board changed the rules allowing insiders of Moderna to sell. Then they issued a press release on partial data of their trial. When I mean partial data, there were 45 participants in the trial, and they released partial data on 8 of them that was unsubstantiated and contained no supporting data for other doctors to do what they usually do, which is go to work, testing the data, testing it, and reviewing it. There's no peer review here. It was a half-baked press release, shot the stock up 30%, and then they pulled a trigger on a $1.4 billion secondary offering to raise money for the company. And insiders, including the CEO and the CFO, sold $30 million of stock. And by the way, they've been a seller ever since. And then, of course, the stock goes all the way back down from about 90 to 50. So they're gaming the system, folks. These are smart players, and they have bought the system. They own it, and they are playing it, and they're relying on the government to do what they always do, which is react like children in a scary movie. They've thrown billions of dollars. Moderna got a $500 million grant recently, and they have no product. And they're the so-called leader in the vaccine race. Look at this one, Kodak. You see this one the other day when they signed an agreement that Kodak was going to manufacture drugs, which they have never done before. Kodak is a dying company. Kodak, the only chemical business they have is in the photography space. And they started an aggressive lobbying effort April 1st, spending almost $1 million targeting through lobbyists, the Department of Defense, a number of different government agencies that they thought would be in charge of the COVID response. The chairman goes and buys 47,000 shares of stock. He was awarded options, 1.75 million options, stock options. Then they announced this loan from the government, which if you look at it, it's not a loan, it's a letter of intent. It's not a loan. There's no money changing hands. Talking about a partial release or partial data or a partial agreement, this is it. And the stock shot from $2 where it had been forever to 30 something, okay? There's nothing here, okay? But this is the world we live in. It's a pump and dump world. These executives are very smart to take advantage of what they can count on, which is the government indiscriminately throwing money around, billions of it, in a panicked mood, and they're going to be making a fortune selling into the stream. And by the way, ignoring hundreds of smaller companies like Cytodyne that have very good potential to come up with vaccines. It's an inside ball game here, folks. It's so upsetting to me, as you can tell. Anyway, now I'm going to go into more of the speculative frenzy that I covered last webinar. These are retail favorites. These are retail investors. Look how they are outperforming the smartest people in the room. This won't last. It's driven partly by this guy, Dave Portnoy of Barstool Sports. And because sports have been shut down and he can't gamble, he's been gambling on stocks. And he's become this Pied Piper of Robinhoodies. We all know what Robinhood is by now. It's the so-called free trading app. Millions of young people have signed up and they're gambling on stocks. Here's how far this guy's come in the world. And our promoter in chief, Donald Trump, who's one of the great promoters of all time, as you know, is elevated Dave to status of being a buddy. Look, again, neither party has a monopoly on bad ideas. I really personally do not like Donald Trump. Full disclosure. His policies are good though. Deregulation, cutting tax rates. His policy instincts are pretty good. But the noise he creates, oh my goodness. And giving Dave Portnoy this kind of, I guess, what do you call it, platform is upsetting. So this is what happened the other day. Grin is a new Bitcoin surrogate. And this is from their website. It's a private and lightweight Mimblewimble blockchain, okay? This is Grin, and it started to be promoted on Twitter. This is a blockchain, I'll remember, surrogate. So on Twitter, these guys start tweeting about it's coming, there's nothing anyone can do to stop it, promotional, obviously. Grin, so many scared hands, this will go up from here. Relax, have a drink, and buy some crypto. And then kids on Robinhood started buying this, Grinrod Shipping Holdings, a stock, ticker GRIN, Grin. Once again, this is a Bitcoin product not sold on Robinhood. And they take this company that is a dry bulk shipper going through a downturn, secular downturn in their business with lots of debt and hardly any fundamentals to speak of that are attractive. And they take this stock from 3 to 7 based on this. And look, influencers shot on Twitter by Grin, and then they realize, oh, we bought the wrong thing. And it retraces. Why do I bring this up? Because it's so reminiscent of 1999 that I have to. And by the way, it can last forever. But if you think this is a real investment market, if you think that the upward move every day is genuine and based on fundamentals, you're wrong. And if you think it can last, you're also wrong. This kind of speculation will end up creating havoc for those who are indulging in it. And then I'm going to go into my last Forbes article. You can see there 41,800 views, so I'm kind of proud of that. But remember here at our firm, Trustco and N3L and related companies, We can never have our rose-colored glasses on. We believe neither party has a monopoly on bad ideas. We believe the government is the 800-pound gorilla in the economy, defining incentives, positive and negative. We believe that the government policies rearrange incentives in the real economy and then prices respond. We find ideas from that framework. We avoid disasters by following that framework. And we can never believe what we read or hear. We've got to do the work ourselves. And over the last month, polls are coming out basically telling us the election's over. Look, it may or may not be. I'm not making a judgment on that. But we decided to take a look at the polls. So we did, and we do every day. Every poll, or most polls, actually will tell you, or will have somewhere the data, which show the cohorts that they are surveying. Their ages, their sex, whether they're married or not, but most importantly, their party affiliation, and whether the Democrats or Republicans. And they are routinely polling 9 to 10% more Democrats. Well, you might say Donald Trump, the scoundrel, has created that many more Democrats. No, he hasn't. When you look at where party identification falls over the last 6 months and years, actually, it vacillates a lot. It's not seasonal, but it does move around a lot within about a band of about 4%. You could say the Democrats might hold about a 3% lead there now. I'm not sure really if that's the case, but it appears it. Okay. So they're polling 9 to 10% more Democrats than Republicans, and they're telling you that it's a 10-point spread in the election. We'll tell you that when you include the margin of error, that it's about where it was in 2016 between Hillary Clinton and Donald Trump. She appeared to be ahead by about 3% coming up to election day. So there, the bottom left, this election, this is my opening sentences of the article. This election has the potential to roil markets. Cities could collapse if Trump wins, and I believe that. Markets could collapse if Biden wins, and I believe that. So with 100 days to go, polls are going to be affecting the narrative. If you're an investor, you need to do your homework. You need to go into this election knowing, or at least with a sober view of what might happen, because the two policy directions are going to be wildly different. Remember, Biden is suggesting that they're going to address racism with Fed policy. MMT is going to be something that they are going to push. Modern monetary theory, which says that Fed can just print money and pay directly checks to people. They print money and send me a check. They print money and embark on a $2 trillion, say, infrastructure building binge, bypassing the Treasury, bypassing the debt scheme. What does that mean? It's important to think about it. Inflation, you bet it does. The devaluation of the dollar, you bet it does. The collapse of the whole system, probably. Anyway, I've touted my article here, and then I'm going to break this out open into questions, Q&A. And so if you have questions, there's a mechanism for doing it. This is the first time, by the way, that we have used Teams. We have been using Zoom, but I'm short the stock, so I decided I would not use Zoom. I'm kidding, I'm not short it, but I want to be. $70 billion market cap, 500 million in revenues. Just doesn't seem logical. So anyway, I'm going to Q&A here. First question is, do you believe companies in Operation Warp Speed, which is again, this effort by the government to speed up development of a treatment or a vaccine, do you believe that they will deliver a vaccine by the end of 2020? And the answer is absolutely not. The odds of that are about 0.01%. I don't care what Trump just said. He's wrong. He's promoting again. Remember back in the HIV days, you may not remember, but in the 90s, the political pressure was almost unbearable to find a vaccine. blame was going around that the reason they hadn't found a vaccine was because they were prejudiced against gays and lesbians or whatever. The political pressure was insane. They threw billions of dollars at the effort. And guess what? We still do not have a vaccine against HIV today. So the odds are low that we have one by the end of 2020. And they're probably still low that we have one by 2021. Now, a treatment is different than a vaccine. I think there will be some effective treatments. Why am I bullish on the junior gold miners rather than the larger gold miners? It's a valuation disparity. Barrick and Newmont are trading at much higher multiples of revenues and cash flows than the junior miners. The junior miners are just cheaper, much cheaper. Oh, and by the way, when you look at the amount of gold that Newmont and Barrick, the big miners, have as reserves, it's limited. They're going to actually have to go buy reserves. They're going to have to go buy supplies of gold to keep mining it. They're going to buy some of the junior miners. Plus, they're cheaper because they're not on anybody's radar. The way the gold trade works, like anything, is people look over and go, whoa, what's the action over there as gold prices rise? And they go buy GLD or one of the ETFs, or silver, SLV. They buy the ETFs. Then if it continues to work, they'll go buy Newmont and Barrick or maybe GDX, which is the ETF of the larger gold miners. And if the trade continues to work, they'll move down to GDXJ. And if it continues to work, they're going to go find these junior miners and development stage miners, which development stage have one mine or they're developing one or two mines. They're not on anybody's radar. And by the way, there are hundreds of these things that are public. So it's a matter of they're cheaper. It's a matter of the fact that they have reserves and that there's going to be a great deal of M&A activity. Okay, those are the only two questions I have at this point. Do I not have any more questions on this team? Oh, I got new ones. Don't leave me. Will the Fed's desired, just lost the one. I wanted to address that one. Give me 2 seconds. Will the Fed's desired inflation be more negatively impactful than overpaying for a house in an inflated Nashville housing market right now? That's funny. Housing prices are ripping right now. Did anybody notice that? Nationwide, because of the demand shift out of cities. But food prices are rising too. Did anybody notice that? Proteins, which are of course poultry, pork, and beef, those prices are continuing to rise. Inflation, by the way, I'm going to go back over it. Inflation is a hotly debated topic. The second people think it's impossible and will never happen again, you better think converse to that, okay? And inflation is too much money chasing too few goods. Okay, we got the too much money. Where do you get too few goods? Well, you get it in a production decline. You get it by shutting down factories. You get it by moving production away from China to other countries that are more expensive. And so I think the Fed's inflation will be very negatively impactful, to answer your question. And then somebody made a comment, only 57% of Americans would take a COVID vaccine anyway. And did you realize that when you look at flu vaccines, they are only 30% effective? They're only 30% effective. That's why some people refuse to take them. Okay, gang, that's it. I'm wrapping it up. You've been fabulous, but very quiet audience. And thanks for attending the Trustco N3L webinar. And I hope you have a wonderful afternoon. Bye-bye.